Well, I was asked what I might say. I said, I don't really have anything to say. And so they said, okay, put on a suit and moderate. So I'm going to be the moderator and not a speaker here. We have a great panel. I'm not going to spend a lot of time introducing the panel since we have great bios in here, so I'll let you look at them. Chris Whalen is down here at the end, and then Jerry Webman is next, and then Mary Ann Bartels. Is it Bartels or Bartels? And then John Sylvia is sitting here, so you can kind of identify the players. So we'll try to keep this fairly free form. We'll be watching for questions out there in the audience. If as we go along, if something burning really pops up, why go ahead and stick your hand up, and I'll try to recognize you. I've had a lot of practice as a former professor. So I think we've learned a lot today about how important having perspective is, and I have an interesting story that I can share with you about having the right perspective as you approach a problem. As you know, Charlie Plosser is retired from his role as president of the Philly Fed, and as part of his retirement package, they send him to the doctor for a full, complete physical exam, and he gets to pick his own doctor. He goes to his whole family doctor, and they're doing the concluding commentary, finding out how well he's doing, and we're done with that, and Charlie's in good shape. He says, but could I ask a personal question? And the doctor said, of course. He said, you know, I think my wife, Janet, is losing her hearing. But I don't know how to bring the subject up. I don't want to hurt her feelings. I really don't know how to deal with it. So maybe you could give me some suggestions. The doctor said, sure. Here's a really simple thing you can do. Get a couple of rooms away from your wife and then holler out a question. And if you don't get an answer, then go to a closer room and holler a question out. You know, not real loud, but you know, normal type voice. And if that doesn't work, you know, then move closer, and you'll get a sense of what the problem is. So he goes home and he goes into the living room and yells out, "Hey, Janet, what's for dinner tonight?" Nothing. So he moves into the dining room. "Janet, sweetheart, what's for dinner tonight?" Nothing. So he moves from the dining room into the kitchen. He's standing a few feet away from her. He says, "Janet, what do we got for dinner tonight?" She turns around, puts her hands on her hips, said, "For the third time, Charlie." So, how you understand the problem and how you approach it is really important. We've learned that. So, what we're going to talk, I think one of the things we ought to talk about is kind of what are the factors that we should be watching to anticipate the developments in the financial markets. That's the title of our session is Financial Market Developments. We should really be thinking about not just getting a forecast, is going to be better or worse, but what are the kinds of things we should be monitoring to try to figure out which way things are going to go and what we should be doing to take advantage of that or to protect ourselves from the developments that might be coming along. So I'm going to start with Chris, and you can see he's a guy who decides whether deals are any good or not and puts numbers on them, you know, like ratings. Low interest rates that we've had now for a very long time make, you know, cash flows look a lot better. As we know, we got a good lesson on that from Paul and others who have commented about the whole present value thing. So we've been looking at cash flows and valuing them at very low interest rates, even though we all feel like the interest rates are too low. So, you know, your job is to look at a new deal, which these people might invest in, and decide whether or not it's a good deal, knowing that it's all about the future. So how do you deal with that at Kroll? How do you make those kinds of valuation decisions or rating decisions as you make that judgment?
Well, thank you, Dunk. As he said, I'm head of research at Kroll Bond Rating Agency. I also run about half of the business. I'm responsible for financial institutions, corporates, and sovereigns. Let me start from the macro view and work to the particular because we've had a number of really good speakers today, and I think they said some very important things, particularly Paul McCulley's accolade for the Fed, which I share to some degree since they didn't really have a lot of choice. But as I've said to him several times, it's fine to stimulate asset prices and lower the cost of debt by keeping interest rates near zero, but if you don't make income go up, When you stop doing what you're doing, then asset prices have to go back down. In other words, if you don't make income validate those higher prices, then essentially you haven't really fixed the problem. In the bond market today, you have a situation where banks, pension funds, insurance companies are literally starving for yield. And what this has done, and the Fed wanted this, was to increase their tolerance for risk. So they're going up the risk curve looking for returns. And you can see in markets, as John Cushman said this morning, like commercial real estate, some residential real estate, and many, many other asset classes, that the effect of the solution, if you will, from the Fed has been to change the preference of investors so that they will accept greater risk and lower quality from issuers of securities than they might have done in a different interest rate environment. One example of this is an area where we've been very busy for the last year is banks. We were the first of the rating agencies to be willing to rate smaller banks, small regional banks and community banks as small as $1 billion in total assets. Well, why do we do this? As it turns out, small banks actually did much better during the crisis than large institutions. Large institutions had a 50% failure rate, if you think about it. We lost a few hundred small banks, but by and large, the population of little banks was very stable. They fund themselves off deposits, and they don't have to get voted on by the bond market every day, the way a big bank does. The yields on those securities, even for small banks, are quite attractive. They're down in the low fives. You have insurance companies fighting with one another to buy these deals very aggressively. In fact, we are coming out next week with a securitization, the first securitization of small bank debt since the crisis, and we were the only rating agency that could do it. If you look at all the other asset classes that we cover, corporates, I have a very active aircraft team in the aviation space. Again, what do you have? You have big insurance companies dragging assets behind them, coming to us and saying, hey, can you rate this deal for me? And they are willing to accept yields that 5, 10 years ago wouldn't have made any sense at all. So when I look at the marketplace today, the thing I worry about, since I wear two hats, one is my operating responsibility for doing ratings, the other being research, I worry that once we do normalize interest rates, if we normalize interest rates, we are going to face a very interesting process of repricing debt from, say, where it is today to where it might be if Fed funds was at 1 or 2%. And the long end of the bond market adjusted accordingly. You know, another example, energy. You heard what Mr. Cushman said about Houston. We have been polling our banks for the last year and more to talk about their energy exposure. By and large, especially the little banks, have done quite well. They underwrite and manage credit very effectively. But why is it that all those guys in the shale sector haven't failed in greater numbers? It's because they could go out and raise more money. There was an investor standing there waiting to give them more money, even though they're losing money, even though some of them are operating a net negative cash flow right now. So I think for all of us, we have to remember that line from the movie The Matrix when Morpheus is showing Neo for the very first time the real world, and he turns to him and says, "You think that's oxygen you're breathing?" You know, we are living in a highly managed, regulated market that is really a simulation. You know, there is no short-term money market. It's the Fed. We don't really have a short-term repo market, except for high-quality institutions with very, very tight collateral requirements. So I guess, you know, the guideposts that people like us use in the investment world to price risk, to try and make asset allocation decisions, to make rating decisions about an issuer, are not, in my view, really transparent at this point. And I don't know if a rating I give an entity today and where it'll be 3, 4, 5 years out is going to be using those same benchmarks. That's the thing that worries me the most as a financial professional. I'm a banker, by the way, by background. The other bankers who deal with me hate me because I'm one of them. And yet I have to, put my fiduciary hat on when I'm working as a ratings professional, because even though the issuer pays us, ultimately I work for the investor. Ultimately, I have to inform them as to whether or not they ought to buy a security or not. And the thing I think that's interesting is if, the speakers we just heard from, if they're right, and if we can normalize rates to some degree, okay. But to step back to the macro, just to wrap up, I want to hear my other colleagues. Population growth in the U.S. is 0.5%, 0.6% a year. The other factors, debt, everything else, I think are weighing on economic growth. So if you look at it from that perspective, I don't think the Fed really has a strong case for raising rates. My favorite metaphor is aircraft. When you're rolling down the runway in a Boeing 777, you got to get up to 175 knots before you pull the stick up. That's what they call vertical rotation. Well, if you're not going 175 knots and you pull the stick up, the plane rolls into the weeds at the end of the runway, or it stalls. And I think that that's the risk I see as a credit professional, is that if we raise rates, a lot of the deals that have been done over the last 5 years are not going to endure. They're not going to be sufficiently robust to really take that test, that stress, if you will, of a change in risk pricing. So let me leave it there, and then I'll look forward to your questions.
Thanks, Chris. That was very depressing.
Well, yes.
So let's hope the people who are making money, if you wonder why I'm sitting down here, it's sciatica, so just before we started, I took a Percocet to help me out.
No, this should be fun.
They just fade and then they'll take over.
Well, I'm a bond guy, Dunk, so, the equity guys can be happier.
There you go. Well, speaking of that, Marianne, I don't know what you learned from what Chris told you about what you should look for or not, but how do you see these markets unfolding with these kinds of risks and the policy uncertainty that we have?
Sure, that's a great question. I'm Marianne Bartels. I'm with Merrill Lynch, and my title is CIO of Portfolio Solutions. And so what I have to try to do is take what everybody's talking about in this room and filter it down so our clients can make money. And I think what's important to understand is we have two different kinds of clients. We have ultra high net worth. Those will be our clients that are in our private bank that have 10 million or more in assets. And by the way, we have about 14,000 financial advisors. There's only 136 financial advisors in our private bank. The rest of the clients, generally, I would say average somewhere between $2 to $5 million, had a business, sold it, and that's the only net worth they feel that they will ever have in their lifetime. Those two clients are operating very differently. The ultra high net worth client is fully exposed and engaged in the markets and has a very well diversified portfolio. The majority of our other clients are still locked in fear, remembering 2000 and 08, 09. So what we developed at Merrill Lynch was a paper called A Transforming World, where we bridged research, our CIO office, and our trust bank, because we have U.S. Trust under Bank of America, to talk about the major long-term macro themes that we thought our clients should be aware of that are transforming our economy, and then how do you invest in the market. But my challenge is, I'm going around the country doing seminars, but my challenge is when I ask an audience how many people know the history of the stock market, how many people raise their hand? How many people here took a course on the history of the stock market?
It's been my career.
Yeah, it's like 1, 2, or 3. Very, very few. Most of you probably have some type of foundation in interest rates. And normally I joke and I ask, is anybody really educated in the room? Because here, at the end of the day, we talk about all of this, but what does it really mean to you and to your portfolio? So what I spend a lot of my time doing before I even talk about themes is educating people on the market. So I'll be a professor today. If I can get my slides up. It's not working.
Hold it up higher, maybe.
Oh, there we go. Is there here's a chart of the Dow Jones Industrial Average going back to 1900. It's a logarithmic chart. Many of you will understand why I did that. I normally tell the audience I did that so I can manipulate it, so I could draw those yellow boxes. There are periods in our market's history where we trade sideways for years, go nowhere. The average length is 16 to 18 years. But if you look at the last box, we're out of that box. What does that mean? Well, what it means to me is that we're in a new secular bull market, and that's what we wrote in our paper, A Transforming World, in 2013. Secular bull markets last on average for 13 years. The greatest secular bull market of our lifetime lasted from 1982 to 2007. Now, you get bear markets in a secular bull market. From 82 to 2007, you had the crash in 1987. So I'll guarantee you stocks will go down 20 or 30%. The question is, do you get these 50% corrections all the time? And the answer is no. And if you study the last period, 66 to 82, the stock market in 1968 went down 50%. 73, 74 was a very famous bear market. It was called the Nifty 50, and stocks went down 50%. Now, does that sound familiar? In 2000, stocks went down on average 50%, although I was advised that for some portfolios it was more than that. In 08 and 09, stocks went down 50%. So the moral of the story is, if you look at this chart, we still move from the lower left to the upper right. We don't look anything like Japan. We're at record or near record all-time highs within the marketplace. Now, we broke out after 13 years. That's never happened before. And I would argue what we've been talking about is what the Fed did during the crisis in 08-09 is they stimulated asset prices, and we were able to break out earlier. But there's something that's missing from this chart, and that's interest rates. So I took the 10-year Treasury yield, or whatever was the equivalent at the same time, and if I compare the two market periods that I just talked about from 66 to 82, the interest rate environment was completely different, right? And we had an inflationary environment and rising interest rates. Today, we have interest rates falling. We all know that. So I said, okay, well, when was the last time we had rates this low? Well, lo and behold, you're back to the 30s and the 40s. And yes, we operated very differently. It happened to be the last time we had a major financial crisis. We operated differently. But the question is, what is our interest rate environment going to look like going forward? I would argue, based on that chart, interest rates are going to remain lower for longer and not at levels that we're used to. And this is important from an investment perspective, because most of my clients thought they would get risk-free 5%, getting to the cash flow. They're not going to get that. And yes, many of them are taking more risk in the bond market, but what we're trying to educate them is that they can grow their wealth by coming to the stock market, as well as getting dividends and getting companies that raise dividends over time. But no matter which way we slice it and dice it, our clients have to take more risk within their portfolio. Now, cash has to be a component and bonds have to be a component, but that cannot really grow their portfolio at this point. It will add a diversifying factor and two very key diversifying factors to a portfolio. So I spent a lot of my time trying to explain, well, how do you invest within the marketplace? So we have a transforming world, but I'm going to take this up to 50,000 feet in the air, because this is very, very important, has major implications even on businesses. What drove our macro economy for years was agriculture, going back to the 1500s. That lasted for 200 years. Then the steam engine, we had the Industrial Revolution. That lasted for 300 years. We're arguing is we're now in the digital age, and that started in 2000. How many people have even a 6-month-old, an 8-month-old that will take a handheld device and swipe? Right? We have cloud computing. We have big data. Cybersecurity is huge and is going to be an ongoing event, and we spend more than any other country in the world. The second country behind us happens to be Germany. So we have to understand the major drivers. Two of the big themes that I talk about, because we have at least 5 of them under A Transforming World, is innovation, because we are in the digital age. And I talk about cybersecurity, I talk about big data, cloud computing, semiconductors. Semiconductors aren't even close to their record all-time highs. NASDAQ is just approaching its all-time highs, and that's the brains of the operation. Driverless cars, and that technology will continue to drive that field. The other part is baby boomers. Baby boomers have been driving our economy since they've been born. Well, where are they? They're entering their longevity phase. So healthcare, which we've always considered to be a defensive sector, is now a growth sector. The demand for healthcare is not going to go down, it's going to continue to rise. The average person between the ages 60 to 80 takes at least 15 to 20 pills a day. Pill boxes are in high demand. Right? And then we have innovation with biotechnology. And then our mental health is going to be on the decline. If you ever look at the cognitive charts, by the time we reach 70, our cognitive abilities peak and we're on the slope down, right? So we have to talk about dementia and healthcare services. So healthcare is in a major bull market. It's not defensive anymore, it's growth. So as much as everything that we're talking about is important, what I have to do is take all of this, drive it down, and how do we develop and build out a diversified portfolio for a client, because we're living longer, and a lot of risk to our clients is that they're going to outlive their assets. And it's about educating our clients and about teaching them that they can't go online every day to look at their portfolio.
You're right. Please don't. Do you?
Absolutely not.
How often do you look at your portfolio?
If I look at it once a year, it's a big deal, because I'm 90% exposed to the equity market. I have basically no cash and just a couple of bonds. It's the only way I'm going to, based on my genes, I should live way over 200. So if that holds true, the only way I can't grow my assets in cash, I can't grow my assets in bonds. So I have to take full risk and almost be 100% exposed to stocks.
Well, Jerry?
Yes, sir.
How's that for advice?
Well, I just found out that in 4 years I'm going to start getting stupid, so I'm a little bit nervous about that. Some of you, by the end of this panel, might think that that started 4 years ago and not 4 years from now, but it could happen. I want to go back to Aaron's joke from this morning about the economist and the sheep. I thought the punchline was going to be something about how I knew you were an economist because counting sheep and talking about economics have sort of the same sleep-inducing effect, and I thought that was going to be the punchline, but I guess we sort of missed it. So Marianne is correct that many of us, not just in the U.S. but globally, need to find ways to have growth in our portfolios. And that's just so remember when he's got to take his next pill, or maybe that's when I have to take my pill that I got to take. We have to put because we don't remember when we're supposed to take those pills. So if Paul McCulley is right, I mean, we have to think about it. I guess I'm running together a few streams, and this may be confused for a minute before, and I hope I'll be able to pull it together in something sensible. We've heard a few things. One, whether it was Charles or Axel who said, "Why stop talking about us so much?" I would say to that, bravo. I think in general, in a capitalist economy like our own, by the way, even in a red flag economy like China, I think we have to pay less attention to what government has done. Just to be contentious here for a moment, I don't think over the last, let's say, at least 6 years, there are very many of us who've been delighted with what's gone on in Washington. And I don't care whether you wear a red suit or a blue suit, you probably aren't happy about it. The process hasn't been pretty. On the other hand, there have been a wide range of businesses around the world, leading in the U.S., that have been able to make money in what's not a perfect environment. You know, the Affordable Care Act, Obamacare, love it, hate it, it creates winners and losers. So there are times that you need to focus on government, but to be, you know, whether you, depending on your religious tradition, either scholastically or Talmudically focused on every word that central bankers say, I think gets us away from paying attention to who is really creating value in an economy and who can make money doing it. And if Paul McCulley is right that we've come to a point where, in fact, the crisis management that the central banks have engaged in different cycles over the last 6 years have meant that really we're now at very full valuations. We've done about as much as central banking can do to the denominator of that Gordon equation, and what's going to have to drive it now is the growth, the middle variable in that equation. It's going to have to be whether that growth, it can be sustained or not, and that's going to come from actions that happen almost everywhere in the private sector. So we should be focusing less on what government does and does not do, including central banks, and more on the kinds of issues that Marianne just raised. Where is there technological change? Where is there disruption? I thought Axel's point about UBS and the way in which very large institutions have to face the threats that financial or biotechnological or information technology advances are disrupting old business models is critically important. So some of those small disruptors will be important. Some of the, as a book of 20 years ago said, some of the elephants that learn to dance will also be valuable. But we're going to have to figure out where they are. Spending too much time watching our favorite cable news channel and getting, I used to say to my kids when they were growing up, don't waste your time listening to people who agree with you. So, which I think is probably important. It is too easy to do that now. So the time to be spending is not on listening to the cable news channel that you like listening to, but trying to figure out what those changes are and who stands to profit from it. I guess the other thing I would want to say, and we'll come back, have some thoughts about normalization of central bank policy, and we should talk about that. I think the issue, the gentleman who talked about his 6-year-old and learning to ride a bike, I have a 20-something-year-old who's a pretty strong athlete, was a college athlete, did very well. He cannot ride a bike. The reason he cannot ride a bike is that when he was 6 years old, I took the training wheels off too soon. And so he never got the confidence to do the one thing that we all learned to do. So there is an answer that there is something important in government policy. But I want to come back, whether we're looking in the U.S., we're looking in those great European multinationals who now have the wind at their back, in my opinion, or we're looking at the emerging markets, and we should talk about China and its growth prospects, where there is great opportunity for growth with better with better demographics, with better opportunities for productivity to increase. We got to be looking for those opportunities around the world, and that's where we've got to find that G in that Gordon equation, in that Gordon ratio. We've got to be finding that G is now going to be driven by what private businesses are doing, and that's where I think we need to be focused.
I like that. Private business. Sounds good. All right. Not to last guy. I mean, what can I say?
Thanks, Tom.
Here we go.
Okay.
Well, I have a story about the last guy.
Oh,
a story about chief economist. Somebody calls the office and says, I'd like to speak to the chief economist about interest rates. And the secretary says, I'm sorry, but it was a really intense open market committee meeting and the chief economist passed away. He says, thank you, hangs up. Next day, call comes in and the caller says, I'd like to speak to the chief economist about interest rates. And the secretary says again, I'm sorry, but the chief economist passed away this weekend. The funeral is a couple of days from now, so I'm afraid can't help you. Okay, thank you. Next day, the call comes in, and the same request. I'd like to speak to the chief economist about interest rates. And the secretary says, aren't you the same person that's been calling me? Your voice sounds familiar. He says, yes, that's me. He said, well, don't you understand? The chief economist passed away. The chief economist is dead. And he says, yes, I'd just like to hear you say it. And with that, we have the chief economist for West Park.
I just have to say, speaking of disruptive technologies, you should know none of us has a secretary anymore. So
that is also true.
So I'll just close this session with some brief comments, and
then we'll do Q&A.
Then we'll do Q&A. And I think, first of all, the comments about signals, etc. I think it's important to understand the economy constantly evolves. It's never the same. And so for those of us that have been around, we know clearly the 1960s were not the 1970s, the 1970s were not the 1980s, and on and on. So I disagree entirely with the concept that there's a normal economy. There is no normal economy. The economy is constantly changing, constantly evolving, and we always have to deal with that new reality. I think the second point that's really key is there is a clear credit cycle. Things go up, things go down. It happens all the time. And I think right now, as we sit in the sunshine, we're going to have to remember that it rained earlier this morning and it may rain tomorrow. And we need to be very, very thoughtful that, at least in banking, the worst loans are made in the best times. What oftentimes happens, particularly, don't forget, we're in the 5th year of an economic recovery. For those of you that are familiar with Excel spreadsheets, especially Excel spreadsheets done with junior people, after about 3 years, year 4, year 5, and year 6 disappear. So now we're dealing with the situation that most of our credit officers have no recession in their Excel spreadsheet. So they have no idea what they're doing. I think when you sit in a trading floor of an investment bank operation, you realize that at least 1/3 of the people on the trading floor were not familiar with 2007, 2009. So that, 1/3 of the staff has no idea what that's going on. As far as indicators, Bill, you asked earlier, if you want my one single best indicator of the U.S. economy, it's jobless claims. If you do the graph, it's pretty obvious where the recessions are. The problem is also when you do the graph, you don't get a lot of warning. Jobless claims really spike really quickly, and so we can sit here today and not realize that we're in a recession a year from now. So I think that's very important to recognize. As far as the credit cycle goes, one good indicator of the credit cycle that I like to look at is the Senior Loan Officer Survey published by the Fed. It's all public information. But if you look at that, you can see a very, very clear credit cycle in terms of commercial lending, business lending, and individual household lending. So I think that's really key. I will pick up on the third point that was made this morning only in the context of commercial real estate. But as far as residential real estate, I think it's very important to understand it is very much micro markets. I think one of the experiences in driving around Wyoming and Idaho in the last few days is we've gone through, my son-in-law and I went through a number of towns that you know darn well there's no economic growth, and incomes are incredibly low and the FICO scores are really poor. We're not going to lend there. But then you come to Jackson and certain parts of this area and everything is booming. And so residential markets are characterized by two problems. One, they're incredibly micro markets, and the second problem is that when you're dealing with credits, we have a national market on credit and we have local real estate markets. And so for many of us, one of our great problems is we have booms. I mean, for those of you that have been to San Francisco lately, one of the great problems in San Francisco is south of Market. If you've ever heard of a firm called Salesforce.com, I mean, south of Market, you have this huge influx of very wealthy, very well compensated employees that is changing that marketplace dramatically. The other thing that's a challenge for us in residential real estate is millennials, because as many of you know from your experience with millennials, they have the most amazing kitchens and bathrooms, and they're willing to sacrifice and live in 800 square foot apartments. So to me, when you have an appraiser go out and look at the square footage and look at the price per square foot, it's totally out of the bounds of many of the guidelines that the bank will work with. And yet, again, a lot of these properties are really key. Let me just close with another point with respect to the evolution of risk and the cost of risk. As many of you know, in terms of public information, Wells Fargo capped its subprime auto loans. It doesn't mean we can't make money on subprime auto loans, but we just can't chase that rabbit anymore. And so again, 4 or 5 years ago, we were making a lot of auto loans. We're not doing so today. And the same thing with business loans. So again, I think it's very important to understand that the credit markets change over the business cycle, and you have to be aware of that. And again, in a way, recognize it's sunshiny right now. It could easily be raining tomorrow, and the people that survive are the people who bring the umbrellas.
Slides.
No, I'll skip this. Oh, let me pick up one more point. A lot of people love to talk about disruption and all this other nonsense. Okay. The problem is, you have to, as an investor, you have to judge, is this disruption going to be allowed? Anybody in commercial real estate development knows it's a pretty piece of land. I'd love to do the development on it, but there's no way in God's green earth that the local representatives are going to allow you to build. Okay? I had the privilege a couple of days ago to be with a fishing partner, totally different business. But he was expressing to me the problem that they've gone through regulatory review with the federal government trying to get some knee brace approved for more than 9 years. So you can talk about disruption all you want. I want to know, where are the disruptions that are going to be allowed? That's what I want to invest in.
Thank you, John.
Can we comment on one another's comments?
We're going to do is going to toss it right back to you and ask you if it's any easier to value and rate bond deals now that we have all this wonderful regulation.
Well, that's a very good question.
You can go wherever you want to go.
Well, no, I'll start there. Since the crisis, the folks at the Securities and Exchange Commission have decided that they're going to regulate the rating agencies, and this is a work in progress. Since we're the smallest player, and we also didn't exist in 2008, we escaped some of the more onerous strictures that are put on the other firms. But suffice to say, it's not helping credit creation. It's making the industry more mechanistic. We have to check the boxes, and particularly if you read the research that's published by my larger competitors, it looks like it was written by a machine, or maybe more specifically a lawyer. And the reason for this is that having been sued and gone through settlements with the Department of Justice and everything else, the folks at Moody's and S&P, unfortunately, in my view, are dumbing down their research. They're giving less information to investors because they don't want to take risk. Okay, so that's enough on rating agencies. To Sylvia's point, what is going to be allowed is a very important question. Most big banks today, I mean commercial banks, are not going to lend you money as an individual unless you have a FICO score that's well north of 700. Does everybody know what a credit score is? Why is that? They don't want you to default. They don't want to get sued. They don't want to have Mr. Holder and his friends at the Department of Justice demand a big settlement from them. You know how they get these settlements? They threaten the board of the bank with criminal prosecution under a law that was passed during the Civil War forbidding profiteering. That's how all these settlements have come to place. We don't prosecute fraud, but we extract settlements from the shareholders of big banks. Okay, so that really stifles credit creation. Now, on the other hand, there are enormous opportunities because since the banks have been put in a box, or at least the big ones, the little banks who are much more profitable and much more stable and tend to have management teams who used to work at big banks, who have their net worth invested in a little bank, they're growing quite nicely. They have higher margins, they're lending, they're the ones who make commercial loans in communities like this, they're the ones who will make a loan to an individual who maybe doesn't have perfect credit, because they'll work with them. They're in the same jurisdiction. They haven't sold the mortgage to somebody across the country. Little banks, non-banks, all of these are very interesting investment opportunities, but what's the downside? They're not as liquid as the big guys. Going back to what our colleague was talking about before, most investors who deal with big Wall Street firms, what are they looking for? Liquidity. They want to get in and out, right? If you buy the equity of a small bank, it's private equity. You got to wait till somebody buys the bank or they buy the shares from you, right? But you're going to make much higher returns if you can tolerate that risk. Our friends at Hero, this is the kind of stuff they do. They look for those long-term opportunities. So to me, that's the bright side. I didn't want to make Dunkelberg depressed by, talking about how difficult it is to rate certain things. But, to me, there's good and bad on the street right now. There's wonderful returns if you are patient, as she was saying earlier. But you're not going to find it in large cap banks, I'll tell you that.
So Mary Ann, if you got all your money in stocks, are you patient or are you ready to pull the trigger to?
Oh, I'm patient. Because I know if you study the history of the stock market, I mean, markets go down. You should never be invested if you don't want to take risk within the market. The question for a lot of our clients is the market going to go down another 50%. Behavioral finance teaches you that clients only really remember, or investors only remember the recent past. The recent past is ugly. It's 08, 09, it's 2000, you lose money in the markets. And so that's how they're operating and behaving. And when in fact, what the market is really telling me is something has already changed within the marketplace, and the principles that we should be using to invest have changed based on the last cycle. And what's changed is we're now in the digital era. And what's going to drive our economy is going to be very different than what it was, you know, even 10, 15, 20 years ago, no less 100 to 200 years ago. You know, water, we take for granted in this country, not so much in California. When I was in California, all they wanted to talk about was water. There's water issues in India, there's water issues in China, and we talk about it because water is a commodity, but it's the scarcest commodity right now on the planet. And most of the fresh water on the planet is at the polar caps, and we can't even access it. So these are the type of things that we talk about, and then we say, well, then how do we take all of these things that are driving our economy and global economies and put it in the portfolio? And those are the things that I have in my portfolio, and I just know that markets will go down, but I'm not going to trade them.
All right, well, let's have questions from the floor. We got our microphones out. Here's a question right here. And then one right there.
Okay. This sort of brings together what Chris said, Mary Ann, with what you talked about. You talked about being patient and being involved in equity. And Chris talked about liquidity is not where the returns are. Illiquidity is. So within your equity portfolio, are you all in, are you basically in tradable equities today? Are you doing private equity or any other elements around that?
Well, we have 15 different asset allocations at the firm, and depending on the client's liquidity, right? So I can never give one answer. But in general, for clients that would be in a private bank or people that have capital that they can put at risk and hold for a long time, a fully diversified portfolio is stocks, bonds, cash, and alternatives. Alternatives are real estate, commodities, private equity, hedge funds. And right now within the market, because of the volatility, we'd rather own large cap, high quality names. You tend to get more liquidity in them, but if you study the liquidity of the stock market, that's even changed because most of the shares used to trade on the New York Stock Exchange. Now we have 50, 60 different venues where you can trade. Now we saw the New York Stock Exchange shut down for the longest in its history, and trading went on as normal. So liquidity, there's certain liquidity issues even in the equity market as much as we talk about liquidity in the fixed income market. But with that said, small cap over a long period of time give you the highest returns. And so a well-balanced, diversified portfolio would also hold small cap. But if you wanted to be more sensitive, you're concerned because markets are up 6 years in a row, you're near record all-time highs, we would suggest that clients own high-quality, good companies, good balance sheets, not leveraged, paying a dividend, and that have the ability to pay dividends in the future, and those that are even buying back their shares.
But Mary Ann, isn't that the point? The low interest rates have been driving equity valuations because everybody's buying back their stock and levering up?
And consumers are shedding. I mean, the consumer sector is shedding.
That's part of it, but if you break down different factor analysis, but what factors are driving stock prices, certainly share buybacks, but what's driving it even more are companies that have free cash flow. That's the valuation matrix that most fundamental portfolio managers are implementing implementing. They want companies with good balance sheets and good cash flow.
Dr. Eisenweiss.
I have a question and a comment. The question is, one of the themes from the whole conference, really, from this morning and this afternoon, has to do with the extent to which people are taking more risk or need to take more risk to get return. But nobody's really commented on whether people are being adequately compensated for the risks that they're actually taking. And I think it's more important.
Well, I just told you we weren't. I told you we capped subprime lending. That's exactly the point. Right. We looked at risk in subprime auto lending, and we said no more. So we did. I did talk about that.
But I'm talking about investors in general. Is that a major problem and concern? The second thing is just a comment on liquidity. Yogi Berra once said that liquidity is what you have when you don't need it, but when you need it, you don't have it.
To answer your question, yes, we do believe that clients have unintended risk within their portfolio. And what we're in the process of doing at Merrill Lynch, particularly within the bond portfolios, is reaching out to the financial advisors to make sure that the clients have adequate exposure. Now, what I would just say in general, because I'm a contrarian by nature, if you look at where most of the money is in fixed income, it's in bank loans, floating rate notes, and vehicles that people believe that they can get a return as interest rates rise. What a lot of clients don't realize is that rates have to rise sometimes substantial amounts in order to even get compensated within these portfolios. So it's also making sure that clients are educated as to what they're invested in. But as for systemic risk in these funds, I wouldn't worry about it, because really what was the problem in 08-09, which I don't believe we talk enough about, is the leverage that was in the system. You know, subprime wasn't a big deal as a percentage of bonds, but it was the leverage that the banking system had, and the consumer was leveraged. It was just a completely leveraged system, and that was the bigger issue. When we look at the stock market today, you can look at New York Stock Exchange margin debt, and if you read most of the articles, they're telling you it's at record all-time highs, and the implication is that this is negative for the market. Well, the people that are writing these articles don't have any idea what they're talking about. Most people don't even know how to use margin debt. I've extensively studied it, and it's really the growth rate in margin debt. And the growth rate in 2000 was 68%, and that's year on year. And in 2008 and 2009, it was 78%. So, you know, and that was really a lot of the hedge funds, because they were completely levered within the market. Today, we stand at about 16%. If you get leverage up around 37%, the market pulls back 7%. So the rule of thumb is if you start getting the growth rate and margin debt above 50%, yes, you have a problem within the markets. But right now, in terms of just leverage, even within the stock market, it's not there. And we know the banking system doesn't have any leverage.
But Marion, the leverage in stocks is irrelevant. Where the leverage was before the crisis was in vehicles that were not disclosed, that were off balance sheet, quote unquote, which is an oxymoron, obviously, right? An off-balance sheet liability, it's either a liability or it's not, right? And this was fraud. I mean, this was a failure to disclose. It was a lot of things. You know, margin debt, I don't worry about that. It's totally irrelevant. It's a healthy sign if margin debt's going up. You want the market to operate.
No, but it's just getting to a certain level where you have an indication of how much selling pressure you can get within the market. Yeah, yes, your bond market leverage is important.
But the number is an order of magnitude smaller than what we're talking about. We're talking about $60 trillion worth of undisclosed off-balance sheet special purpose vehicles, which are also called shadow banking, by the way. That's where the problem was. You're right, but it's a different nuance. Now,
I thought a special purpose vehicle was an F-150.
But no, I think a question with respect to Bob on liquidity. I think for some of you that are investors on that part of the scheme, not the auto loans, yeah, there is a serious question of liquidity. If you just go back to the Wall Street Journal last couple of weeks, there was an interesting article about is there enough floating treasury debt out there to get things done. Also, when you look at liquidity, and I think what Bob is looking at, I'll look at the rapid changes in bond prices, not only the German bond, but the U.S. Treasury rates, high-yield bonds. There's some rapid changes in interest rates suggesting that there isn't all that much liquidity out there in terms of what's being traded in the marketplace. So that liquidity question is very significant for a lot of investors, and for some of you, look at your total return year to date for U.S. Treasuries and high yield, and you'll start questioning what you're doing.
Axel.
Two comments on the current discussion.
Is it on?
Is it on? Yeah. Two comments on the current discussion. So what Marianne said, I think is very important, the sort of being invested long term. If you take the last 10 years and you missed the best 10 days in the market, your portfolio is half the value of what it would otherwise be. So if you're not systematically invested long term in these markets, particularly in the equity markets, you have a big problem. Second, I think the whole view, and Greece will be at the forefront of this, of sovereign debt is changing. When you talk to clients about portfolios that involve bonds, bond is a promise to repay. We're just seeing that tested. You go 10 years back, bonds used to be riskless return. Now it's returnless risk. And people look at bonds differently. Bond portfolios, in my view, because we're in a world, and I would fully agree with what John said, we're in an over-debted environment. There's winners and losers in such an environment. Monetary policy actually helps sustainability of debt. But that means if you're a bond investor, you have a different long-term return expectations. You have to have that in this environment where we are in an over-debted situation. Completely different in the equity environment. And I think our balanced portfolios that used to sort of be lopsided towards debt, they're going to be lopsided way towards equity in the future, because that's the way you actually plug into the economy. And that's not really sort of made it completely in the asset management world and in the view. But I think a lot of people that stay overweight on bonds, we find it a very, very disappointing future if they continue that.
I think the 30-some years of consistent, almost completely consistent declines in market interest rates covered a tremendous number of sins in credit provision in all kinds of markets, and it flattening out. And by the way, one of the chart that Marianne showed that I hope you keep in mind is that interest rates now are much closer to the long-term averages than what we think about over the last 30 years, which suggests they do not go up substantially from here. But it's important to remember that downdraft in interest rates go down, bond prices go up. That covered a lot of sins in over leverage, in misplaced leverage, in malfeasance, as we've heard in the bond market. So everybody is taking risk. You are taking risk. The issue is, do you understand the risks you're taking, and have you properly diversified that risk? Because you're not, if you're an investor, actually if you're not an investor, you're taking the risk that you won't meet your financial goals. So you got to be taking risk. It's just a question of understanding it and then diversifying it.
If I could, one of the interesting things that came out when I was listening to Axel and Charles before is that when the central banks tell you that they want to target 2% inflation, what are they really saying? They're telling you that the global economy has too much debt, because over 20 years compounded, you're taking half of the real purchasing power of a working family away from them at 2%. It may not seem so big, but it is. And so when you look at it, to me, long-term interest rates, long-term observations are fraught with danger, because there are so many externalities, wars, other factors that come into play, that when you just look at those numbers and you don't think about what was going on historically during those periods, you don't really get it. I like to think of myself as a historian who understands economics as opposed to an economist, because when we train these people, we put them in silos, and they don't really try and understand things in a three-dimensional context. So when I look at today, I think that we still have an enormous debt problem, not just in Greece or Puerto Rico, but in this country. We Americans don't like to think about it that way, but we do. And it weighs down growth. It takes opportunity away from the private sector and forces people to do things in terms of regulation, everything else that might not have been necessary if we didn't have a government that could print money ad infinitum.
All right, well, it's time for our 2-minute wrap-up, and you cannot use the previous session with Axel and Charlie to measure a 2-minute period. We'll start with John.
Yeah, start with John.
Okay. Again, when we talk, a lot of people ask about China, and the fundamental challenge for us on China. A lot of people ask about China, and the fundamental challenge about China is, again, the classic problem of can an economy transform itself, realizing that, yes, it's wonderful to talk about the consumer spending money, but you've got an entrenched interest in industries producing products for export. That's a real political battle as well as an economic battle, and I think is very important to watch.
How many people have a cell phone? How many people have 2 cell phones? How many people have cell phones and an iPad? How many people have all of that in a computer? How many people have all of that into thinking of buying an Apple Watch or something related to that? How many people have a car that beeps and talks to them?
Right, that's the critical.
What is the brains of every item I just mentioned?
A chip.
A chip, and chips are nowhere near their record all-time highs. We're in the digital era. That is my free investment gift to you today.
Oh, stop.
All right, Jerry.
The answer to all this, of course, is really much more with the people who are in the audience today who represent a whole series of businesses, because the question is whether this economy or any other economy in the world can, in real output, begin to catch up with the expectations of equity and debt markets around the world. And the success of it is not going to be what a lot of us think about long-term charts or short-term charts or fluctuation, volatility, or trying to analyze central banks. It's going to have to do with the people, and we all know, millennials who are out starting businesses, startups. It's going to have to do with whether what you do in building businesses is going to catch up with the expectations that the financial markets have put on you. So please do us all a favor and go grow your businesses.
All right, Chris, you got the last 30 seconds.
Yeah, 2 quick thoughts. First, I used to be a semiconductor analyst. I'm sorry, Marianne. Semiconductors are commodities. The companies that make them, nobody pays attention to them anymore. And the reason is that one of the downsides of Moore's Law is that they get cheaper and cheaper, and the returns and the leverage for the producers are like this. You have irrational players. They are subsidized by governments in Korea and Taiwan. I'm a seller of semiconductors. How many people here have heard of Lending Club? Raise your hand if you've heard of Lending Club. Do you think Lending Club represents innovation, fintech, new? How about if I told you that that's old-fashioned subprime lending with a bunch of smart guys that figured out a way to take management fees out of a portfolio that starts off charging people anywhere from 15 to 25% annual interest rates, higher than Capital One. But then all the big sell-side firms put their product up on their platforms, and you, the happy investor, get half of that yield. Somebody else is putting the rest of that in their pocket. And yet this is seen as innovative. It's not. There's a bank behind them. You need a bank to make loans and do know your customer and everything else. To me, the biggest problem with low interest rates is it's given the opportunity to people to market things as quote-unquote innovation, which are just the same old story. Thank you.
All right. Well, let's thank the panel. I'll turn the mic back over to our chairman, Michael.
Good God.
Nice job,
I just want to thank you all again for coming out and spending a long, hot, cold, windy, sunny day. Please come back at 5:30. The Garf Automotive Maserati Ferrari after party will be here. You'll be able to corner some of these people and ask some more questions. If not, at least there'll be a drink. So please, if you had a good time here today, think about coming back next year on July 15th. And in the meantime, look us up, www.interdependence.org, O-R-G, we're a nonprofit, and see if there's another event that you'd like to come to. Thank you all again.